Futures trading involves substantial risk of loss and may not be suitable for all investors. Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Monday, November 3rd, officially the start of a new week and a new month, and it was green across the screen for most of the agricultural markets with the exception of lean hogs. Before we get into today's prices, do want to remind you, if you've not signed up for a free trial of our daily commodity commentary, head over to bluelinefutures.com. The upper right-hand corner, you'll see a button that says sign up. From there, submit the information, check the markets that most interest you, whether that be agricultural markets, precious metals, energies, indices, etc. Regardless of what your interests are, there's a good chance that our team covers it. And if we don't put it out in our emails, call the trade desk. We are ready, willing, and able to help at all times. Then, as always, we do our charts on the Blue Line Edge trading platform, which is free and complimentary to clients. So I advise you to, if you have not already, check that out. Give that a demo. It's very user-friendly, whether you're charting, trading, or just monitoring positions and prices. Now that we got that plug out of the way, we can go ahead and get into today's price action. We'll start with the December corn contract. 2 3/4 cents higher today, 4.34 1/4 was the settlement there. And as you can see, still a very, very constructive chart. It looks like we're going to pull back and reject the 200-day moving average, which we so far have. But we're going to reject it with a little bit more authority in today's trade. But the dip was bought up, and we closed near the highs of the session, now within arm's reach of last week's high and the 200-day moving average, so 436, 437. If the bulls can chew through that, I wouldn't be surprised to see it propel us towards that psychologically significant 450 level. Momentum continues to be very, very strong, not just in the corn market, but the soybeans and wheat and some other grain markets as well. And this is a trend that I think is just starting to develop, and that's something we've talked about over the last couple of weeks, is when these grain markets start working together, that's when you get stronger intermediate term trends. Now, is it going to be a straight line? Probably not. So with that in mind, you need to decide if you are a trader or if you're a producer who needs to protect price. If you're a producer, I still encourage you to probably look at rewarding rallies and protecting the floor and establishing protection, especially going into what's a seasonally weaker time of year. If you look at seasonal tendencies over the last 10, 15, 20, 25, even 30 years, this is not a great time to be bullish corn. That doesn't mean we can't continue to rally, but if you're a producer, protect price here. If you need help doing that, give us a shout. We are ready, willing, and able to help. All in all, though, this chart looks really, really good. Over on to soybeans, instead of looking at the daily chart, which is basically a straight shot to the moon, we're going to look at the weekly chart. As you can see, it looks a little bit more constructive, and we're getting out above some big technical levels on the weekly chart. A breakout last week, and so far so good to start this week's trade. And if you have the ability to pull up a continuous soybean chart, that looks really, really good for a breakout. Now, what are the catalysts going to be that keeps this rally alive? Obviously, China has to show up and buy soybeans. The other thing we're keeping a close eye on is South American weather progress and conditions. Planting down in Brazil, about 46% complete. That is well behind last year's pace due to some irregular rains so far. So maybe a little bit of weather premium to start the week, helping prices continue higher. The RSI on the daily is about 83 in that January soybean contract. So again, with corn, I think these rallies can continue and we can carve out longer term lows, but I don't know that it's going to be a straight line, or at least not the consistency of a straight line like we've seen recently in soybeans. I wouldn't be surprised to see us pull back here in the very near term, just kind of shake the trees a little bit with the RSI being so high. So with that said, if you're a producer looking to protect price, I think that you've got to reward this rally. You can either look at some put options or put spreads. Keep a floor underneath you and keeping that upside open. So there's a few different options that, no pun intended, that we are looking at with clients here at Blue Line Futures. And over to the wheat market, wheat breaking out again. Again, all these grain markets look really, really constructive. It looked like we were going to soften up a little bit early in the morning, but buyer stepped back in, taking us out to new highs, the highest levels since about July. So good chart set up there, continuation and breakout above 550, and you're staring down that 200-day moving average near 567. And you can probably just imagine some trend line resistance coming in right around there as well. So that would be the next upside objective. Previous resistance in all of these markets is now going to be support. So again, for wheat here, 535 area, that's going to be support. Break and close back below there, and that neutralizes the near-term chart setup. So a lot going on in the grains. Very, very constructive, but buyer beware. You might start to see some volatility on both sides of the market after such a nice run higher. Now over to the cattle complex. Just kind of wavering back and forth. The cash market was relatively firm at the end of last week's trade, and so buyers kind of just stepped back in, but nothing too crazy. We're consolidating after last week's capitulation. You can see that here in live cattle and then over in feeder cattle too. We're just kind of treading sideways. The thing that I continue to maybe raise a little bit of a caution flag is that, like the stock market, people often say that there's a Fed put or a Trump put underneath the market, thinking that if the market does puke out enough, Trump's there as a backstop, the Federal Reserve is there as a backstop. I think the opposite could be potentially said for the cattle complex, where if we go too high in this market and beef prices continue to get too hot, the administration could come out and you could see additional headline risk. So with that in mind, I think these rallies, any rallies that we get, are going to be opportunities to get some hedges on or potential short positions. Now, the feeder cattle market, as you can see here, it looks like a block of Swiss cheese. There's some gaps in there. The 50 and 20-day moving average, there's a 50% retracement, all right around near 350. So if we were to get a relief rally into this gap here, 345, 350, I think that would be an excellent opportunity to look, potentially looking at the short side. As far as the futures go, you got to have a thick stomach and a thick wallet as well, because these daily ranges continue to be very wide for live cattle. The 14-day average true range right around $4.50, and for feeder cattle around 8.25. So again, manage your risk appropriately. I know we touched on lean hogs last week. Not a whole lot going on there. Volatility still low. Chart looks like a complete dud with just a bleed below the 200-day moving average here in the April contract. But volatility is also very, very low. So if you're playing this market, I think you could potentially look at options either as an outright position or to help manage risk in the futures market. So those are a few things we're looking at, not just to start the week, but to start the month. If you have any questions at all, don't hesitate to reach out. And remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.